Hello, everyone. Today on the Final Bar, it's Tuesday, April 11th. We have Chris Ciovacco of Ciovacco Capital joining us from Atlanta. We'll look at some of the charts he's brought with us to show really how the market has evolved over the last 6 to 12 months. That change of character we talk about often. Speaking of a change of character, big rotation lower with the S&P finishing flat for the day today. Ladies and gentlemen, this is the Final Bar. Hey, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com today from a sunny Columbia River Gorge in Oregon. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. I posted a video on my YouTube channel earlier today talking about bullish engulfing patterns. It's such a great reminder in this sort of environment, even though so much has changed, so much of the market conditions, the market structure have evolved just since I've been involved in the markets for about 23 years or so. The markets will continue to evolve, but certain techniques, a lot of the things hopefully that we share with you on this show, like relative strength investing, the importance of following trends and recognizing trends, the importance of anticipating and identifying trend shifts and recognizing inflection points, using technical indicators like RSI and MACD and PPO, using candle patterns and bar chart analysis, some of the basic building blocks of technical analysis. Even though the market structure has evolved, a lot of those things are still working just fine. A lot of times, the most simple approaches are often the best. And let's reinforce some of the message of simple charting, but powerful conclusions that you can draw from those simple charts here on the Final Bar. We have a great guest today, Chris Ciovacco of Ciovacco Capital. We're going to get to him a little later in the show after the break. For now, let's get to our market recap. Let's talk about what actually happened. We had a bit of a sell-off in the afternoon, which we'll get to here in a moment. But I do want to start with a poll. We always have a poll going on our live stream page at StockCharts.com. We're always asking poll questions on our social media accounts. So follow us on Twitter, subscribe to our YouTube channel. We won't miss to the next one. We asked you recently, what would you feel most comfortable shorting right now? And I'm fascinated to report there was almost a three-way tie between stocks, bonds, and Bitcoin. It's like we can't even decide what to short because everything looks so shortable at the moment. Gold was the only one that didn't get nearly as many votes as the others, still with about 18%. I would agree with the general confusion of these markets, right? We've talked a lot in recent weeks about sort of this sideways choppy phase. And I'll tell you, a lot of my conversations with some really knowledgeable, experienced investors, it's a question mark in a lot of ways, right? There's no real clear direction at this point. So, if I had to pick one of these out of all of them, boy, I'd probably say stocks. I don't know if I would feel very comfortable about shorting any of them. So maybe the question should have been, what would you feel the least not comfortable, I guess maybe would have been the way to phrase that question. But for what it's worth, stocks and bonds getting an equal response from all of you recently, which I think is fascinating. Let's look at the charts and see what actually happened today. As I mentioned in the introduction, a bit of a sell-off going into the afternoon. And if you look, here's a little two-day chart of the S&P 500. We can see the rally through the course of the day yesterday. Yesterday, kind of a decent day, although lighter volume, right? A lot of non-U.S. markets still closed the Monday after the Easter holiday. And so a little lighter volume here in the U.S. as well. Today, sort of getting back to normal. And you can see a nice move higher through the course of the day, but rotating back lower by the end of the day, gave back all of those gains. So the S&P actually finished flat for the day. The NASDAQ composite down about 0.4%. The Dow up 0.3%. So we're back to that sort of very familiar look with the Dow up, the NASDAQ down, and the S&P kind of caught in the middle. I feel like a lot of days recently, and certainly over the last year, if you look at particularly choppy periods in the market, you have the S&P essentially unchanged, but the Dow is up or the NASDAQ is down, or the opposite, the NASDAQ's up and the Dow is down. That shows you that interplay between traditional offense, traditional defense, really cyclical leadership, things like energy and industrials versus some of the more defensive stuff and things like technology, certainly in NASDAQ. And then the more defensive stuff that would sort of drag both of those. And you can see that in the end, the leadership is sort of negating each other, right? They're sort of evening out, and the S&P, our main benchmark, essentially flat for the day. You can see the VIX is up a little bit, about 0.14, let's say, to just above 19, still below 20, which is what we consider sort of our main benchmark. Let's zoom in a little bit here and look at the interest rates, the fixed income markets. We can see a bit of a mixed bag of sorts. The long bond yield came down just a bit. The rest of the curve kind of pushing higher. The short end certainly moving to the upside. Overall, we still have very much an inverted yield curve. So when you're looking at things like money supply and yield curve inversions and what that means for recessionary periods, I would argue all of that still very much in force here in mid-April. The dollar index down about 1/3%. The commodity space, for the most part, all in the green today. The broader commodity ETF that we track, the DBC, was up about 0.5%. Gold and silver having a decent day as well, but crude oil, copper prices, natural gas prices, all moving to the upside as well. One of the really important charts we're going to look at here in a few moments is the chart of Bitcoin. I was looking at how Coinbase was up about 7% or so. I don't know how it closed, but earlier in the day it was up about 7-8%. And that's because Bitcoin, a part of that is Bitcoin getting above 30,000. At this point, there's no real close because we're sort of continuing to trade, but currently sitting just above that 30,000 level. We've been talking about that level for so long because it's a big round number. And if you look back at the history of Bitcoin, just draw a horizontal line at big round numbers like 20,000, 10,000, 60,000, 50,000, you will find more often than not, it tends to turn, at the very least, pause and take a break around those levels, because that's a natural time to kind of revisit the thesis and think, is Bitcoin worth more than $30,000 per Bitcoin? For the moment, the market is saying, yes, indeed it is, with Bitcoin just above 30,000 and staying there. Let's look at a daily chart of the S&P 500, see where things are at today, and then we'll continue on with this analysis of the market. So, no huge change to where we're at, really. The last, where we're at today is pretty similar to the range we've been in for the last week and a half or so. Sort of the end of the week before last, we had that nice push, the close above 4,100. From then, we've sort of stalled out a little bit. We had what's called a bearish engulfing pattern, at the very least a bearish outside day. The day after that high close, we can see from there we've sort of traded around a little bit. We're sort of remaining in this range right around that 4,100 level. So when the market is in equilibrium, sort of quote unquote, what I would describe that to be is buyers and sellers are essentially in agreement, or to phrase another way, the buying power and the selling pressure, right? That sort of inherent demand of people wanting to own more of things and the inherent supply of people wanting to take profits or unwind positions. Those are sort of evening out. There's enough buying power and selling pressure kind of evening out so that the price remains relatively stable. So there's still plenty of trading, but in the end, it nets out to a flat market. What's interesting about a period like this, we were talking about it on the show yesterday, what John Bollinger told me years ago was look for periods of low volatility, because that's usually right before the break, right? The move, right? The big move, either to the upside or the downside, is usually prefaced by a period of low volatility, sort of a sideways consolidation phase. That's that equilibrium that I would argue we're in right now. What it tells me is start to look for signals that we're moving one way or the other. Let's see what sort of signals we can tease out. I'll show you what happened with sectors today and some of the individual stocks on my list. If you look, the MEI sectors, financials as well, all had a decent day, with industrials up 0.6%, energy up almost 1%, financials, materials there in the middle, all of those up for the day. Two sectors actually finished in the red. Technology down about 0.9%, communication services down 0.3%. So two of the three, what we'll call FANGy sectors, actually down today. Consumer discretionary, just a narrow bit above the zero level. Let's look at some of these individual charts. And I'll tell you three individual stocks that I think are worth watching here just to see what sort of signal we get. When I'm looking at the chart of Tesla, what immediately hit me as I was reviewing this among a bunch of charts earlier today is what I would probably call a coil pattern, what you might call a symmetrical triangle pattern. This is a traditional bar chart analysis tool, goes back to Edwards and McGee, what you call the Bible of technical analysis. They wrote all about price patterns. Their comment was when you have a big rally and then this coil, right? A narrowing of the range, lower highs, higher lows, it's usually considered a continuation pattern, which means more often than not, this pattern would resolve to the upside. But it's important to wait for what's called the trigger or the follow through, right? This pattern, this narrowing of the range tells you we're sort of in this equilibrium, and the market's telling you Tesla's worth about 190, 195. And it's been in that general opinion here for the last 4 to 6 weeks. At some point, buyers either take control and push the price outside of this pattern to the upside, or sellers take control, and that's anecdotally what you would say, and get us below that trend line to the bottom. What's important about trend lines like this is one of these is going to break, because by definition, at some point, we will hit the apex of the pattern, the lines come together, and we will have broken one way or the other. So I think a chart like this, draw these lines on, save it in a chart list, and wait to see which way we break. Set a price alert, by the way, is another good way to do it, and see if we can break above this pattern to the upside. The 200-day moving average, by the way, looming large around 214, just above those levels. Or do we break the pattern to the downside? I would argue whichever way Tesla breaks, that might tell you a lot about sort of that emerging growth trade, sort of that growth stock sort of sentiment, to see if there's more optimism or pessimism. And the way we exit that pattern might tell us a lot. Second chart, and I feel like this is one of our 3 and 3 not too long ago. I don't think it was yesterday, maybe last week, is the chart of Amazon, right? When you look at Amazon, the last time that we had multiple days closing above the 200-day moving average was back in December of 2021. From there, we've had a number of false positives, right? We've closed above the 200-day for a day or two, and then come right back below it. The last time we actually spent a decent amount of time was back here in December of 2021, which means since then, all of these rallies by Amazon, I guess by the basic definition of where we're at relative to the 200-day, sort of bear market rallies. If and when we can get above that 200-day, can we power above the February swing high? That would tell me something's different. Now, we've put in a higher low around 90. That's encouraging, but can we follow through to the upside? The 200-day has repelled many advances. Until that changes, how optimistic do you want to be? And to be honest, it's not just something like Amazon. I'm looking at Southwest. I was looking at some of the airlines before we started. Southwest Airlines, similar idea, right? Broke down through the 200-day back in summer of 2021. From there, it's essentially remained below the 200-day moving average that whole time, which means all of these rallies, like in June of last year, in October of last year, in January of this year, in late March of this year, have failed to get above the 200-day. Get excited when a chart like this follows through to the upside. I'm not seeing it just yet. Finally, Caterpillar, testing the 200-day from above. Some of this industrial leadership names struggled a little bit there in February into March. If we break below the 200-day, what does that tell you about the stability, the optimism, the opportunity in this sort of space? Bullish charts tend to hold the 200-day moving average. Let's see if Caterpillar can do that through the course of this week. Let's take a quick commercial break, folks. We'll be back with today's guest, Chris Ciovacco. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. Thanks for joining us every weekday after the close, and especially thank you for hanging with us this week. We're doing it remote. I'm on spring break with my family here in Oregon, and I appreciate your flexibility, allowing us to figure out some of the technology. It seems like things are working just fine today, so we'll knock on wood, continue with this for now. We're going to bring on today's guest, Chris Ciovacco, here in a few minutes. Before we do so, though, a couple quick announcements to share with you. First off, we love hearing from you, particularly hearing about your questions. What are you struggling with? What are you running into? What questions are coming up as you are trying to use the StockCharts platform to analyze these markets? Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. And we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'd love to hear from you and answer your question live on the air on Friday's show. Upcoming guests tomorrow on Wednesday the 12th, we have Mark Newton, who's the technical strategist at Fundstrat Global Strategies in New York. On Thursday the 13th, Ms. Schneider, our friend from Market Gauge in New Mexico, is going to be joining us. Next week on Tuesday, by the way, April 18th, Ari Wald from Oppenheimer. And as a teaser, we will be attending the CMT Symposium, the 50th anniversary symposium in New York at the end of April. On Friday, April 28th, we will be broadcasting live from the stage at the CMT Symposium with some special, fantastic guests. So tune in for sure for that. I want to get on to today's guest, who's one of my favorites, Chris Ciovacco. Chris is the Chief Investment Officer at Ciovacco Capital, coming to us from Atlanta, Georgia. I followed Chris's work for a number of years, and on social media, I tell you what, he tends to share some really thought-provoking, long-term takes on what is happening in these markets. Chris, it's great to see you. Welcome back to the show.
I appreciate the invite, and great to see you as well, Dave.
So help us make sense of these markets. I know it's been a time of struggle for a lot of investors, just trying to get their feet under them as we sort of get into the second quarter. Nice rally earlier in the year, but now we're sort of stabilizing, sort of in equilibrium. We're looking at your weekly chart of the S&P back to 1990. Talk us through this one and what it tells you about the conditions here.
What we're trying to do here, we're trying to have a comparison between rally attempts off of lows that were successful and rally attempts off of lows that were unsuccessful. So the periods that are denoted by the blue arrows, the blue and yellow arrows, so 1990, 1994, 2011, 2015, 18, and 20. So if you're familiar with market history, you know these periods. These are positive periods. And if you're familiar with market history, the red numerals there, 2000 to 2002 and 2007, 2008, those are not particularly good. So we're looking at a weekly chart. We've got weekly momentum. It's TSI, the True Strength Index, available on StockCharts.com. And in the bear market cases, what's different is when price tries to rally back, weekly momentum fails at the all-important zero line. So in the 2002 case, you come up right near the highlight there, and you are rejected. The ball is thrown about 9 rows back. Same thing happens in 2008. Momentum tries to make a run at that zero line, and it just can't hold it. Contrast that with the rally attempts, let's say in 1990, where price comes down. And really what we're looking for, we want to make sure momentum drops below that center line. And then, yes, price is another thing. So what happens there, price gets a little bit extended from the trend. That's the 200-week. The difference is, in this case, you have a short stay, or you come back and you hold at the moving average. So this allows us to take these cases that we're looking at, price action near the 200-week and weekly momentum, and say, how do we look in the present day? And how we look in the present day on the right side of the screen is somewhat encouraging and somewhat tentative. The encouraging piece would be TSI, which was not able to turn positive in 2000 and 2002 or 2007 and 08, has been positive several times, and it was positive at last Friday's close, positive as of Monday's close, and positive intraday today. That would be the good news. And what does that tell us, by the way? That tells us that the weekly momentum is trying to flip from a downtrend to an uptrend. And you can see in the red numeral cases, 2000 and 2002 and 2007 and 2009, that was unsuccessful. And a good way to think about these oscillators, because this is an oscillator, is the failed rally attempts. That's telling you that that was a counter trend rally within the context of an existing downtrend. In the cases that made it, you were able to flip from a downtrend to an uptrend.
So for now, I feel like it's so close to the chart you would feel really good about, but just not quite there, right? It's like you're giving me an unsettling conclusion here, but I see your point, right? It's sort of right at that point. This might be an important chart to watch, I guess, going forward to see if we can follow through above that zero line on the True Strength Index, right?
Exactly. And the same thing with the 200-week. I mean, look at the 200-week there. Well, to me, what that tells you, Dave, is that's institutional support there. The institutions have not given up on this rally, nor are they really sold on this rally. And I would say that's kind of the way I'm reading things. I think there's enough good here to keep an open mind about good things happening. And you talk about equilibrium. The way I like to think of it is, you're in a market, right? What drives price? Because there's a buyer and seller in every trade. Sure. It's conviction. And you're nailing it. The conviction of buyers and sellers at the moment is about equal, and you're not getting a lot of movement. It's looking like this market needs something, possibly CPI at 8:30 a.m. Eastern time tomorrow, to drive this one way or another.
Your second set of charts, Chris, are really, really interesting because it's really telling the story of how the markets have evolved here over the last 6 to 12 months. This first set of charts really goes through October of last year. That was the equity bottom. Can you talk us through these three and what it told us about conditions at that point?
I'll call these the big three. So we've got the S&P 500, we've got interest rates, which is $ TNX on StockCharts.com, and the dollar on the right-hand side. So on the left-hand side, behind door number one, we'll start with the arrow, and that's where the Fed pivots. And what do we mean by that? And what is that? That's specifically November 29th. It's a Tuesday, and Chairman Powell is testifying before Congress, and he in no uncertain terms says it's time to retire the term transitory. And if you go up and you look at price above that arrow, we were in an uptrend. Price was above an upward sloping 200-day moving average. And after that, you can see we slowly over time morph and roll over into a clear and discernible downtrend. And as you mentioned on some of the tech charts earlier in the show, the rally attempts tend to fail at that downward sloping 200-day. And what does that tell us, Dave? That tells us the institutions were waiting to sell at that 200-day, and they used it as an opportunity to sell. So if we go over to interest rates, really the mirror image. So interest rates are kind of tentative before the Fed pivots. They're below a flattish and indecisive 200-day moving average. And then you can see we get a very strong uptrend in the 10-year yield and stay above an upward sloping 200-day. And we can pretty much say the same thing for door number 3, the US dollar, with the exception being the dollar was front running this a little bit with forward guidance from the Fed after it starts. The dollar's already above a flattish and indecisive 200-day, and then it gets strong. One of the key takeaways here is all 3 of these charts were extended from the trend at this point, and when we get to the October low. So the S&P 500 is far away from the trend, the down. There's a lot of white space between the moving average and price. Same thing behind door number 2. There's a lot of white space between the 10-year yield and the trend. And the dollar is way extended at that point, and we know markets tend to be mean reverting. The green arrows is telling us it's not just the October low that we're dealing with there. The Bank of England was kind of the first central bank to blink in terms of the fight against inflation. They had some financial instability. They stepped in and bought bonds. The Fed also changed their communication right around this period and said, interest rates work with a lag. Eventually, we're going to ratchet down these 75 basis point hikes to 50 basis points. So what are we doing here? We're setting a baseline of what a bearish case looks like. So we don't want the present day to look like these charts if you're a stock market bull. So if we fast forward to the present day, taking the exact same charts, and we're asking a couple of questions. Number 1, does the current rally attempt look discernibly different than the failed rally attempts in 2022? I think if you look at these charts objectively, the answer is yes. And number 2, what will we be looking for going forward to help us assess the probability of good things happening relative to the probability of bad things happening? And I'm in agreement with you. We've got a rally attempt that looked pretty good from about January, let's say 6th to about February 3rd, and it's kind of lost a little bit of its mojo since then. And it looks like the market is waiting for a catalyst, potentially CPI, for those institutions to decide whether they want to dump here or do they want to make this thing run.
It's such a fascinating set of charts, Chris. I really appreciate you setting these up. And it really shows how things, I usually call this a change of character, right? The market has a certain set of conditions before, totally different after that. Can you talk a little bit about, we were talking before we went live about the interest rate environment, particularly the Fed. And when you look at the Fed funds futures, the expectations for the May meeting coming up here in a couple of weeks have fluctuated dramatically, right? I feel like 1 week, there's a more likely scenario that rates stay the same. All of a sudden, a week later, more likely that the Fed raises rate. What does that uncertainty about the Fed's sort of future path do to assets now? Or how does that, sort of inform your thinking about the markets today?
First of all, what it tells us is the Fed's forward guidance gets an F- at this point. That's what it tells us. And as I said to you before we started, I consider interest rates to somewhat be the master of ceremonies for all economic and market equations. It is the driver for planning. It is the driver for valuations. And when you have this uncertainty and this high volatility, it's very, very difficult for market participants to make decisions and businesses. I mean, it must be very, very difficult to plan right now in terms of what you're going to do with your inventory. How are you going to build a factory? What is your interest rate going to be? So this is exactly what the Fed doesn't want. And they would be the first ones to tell you that. And they would love to see interest rate volatility calm down. And unfortunately, until inflation calms down, That's probably not going to happen. We're probably going to be in more of this environment where maybe we go sideways longer than we think, even though we have these coils today.
We only have about 30 seconds left, Chris, but I'd love for you to just share, given this uncertainty, given sort of this, choppiness, where do you position yourself now? Is it just a wait and see moment? Don't change anything dramatically and wait to see what the next leg is? Or are there areas of the market where you're seeing opportunity today?
I look at it this way. I always ask, am I allocated properly relative to the charts in front of us today? And to me, that's somewhat of a mixed bag. I'm not all in, I'm not all out. And then you're going to ask that question going forward every day and make sure that you stay in alignment with the chart in front of you, which helps you assess the probability of good things happening relative to the probability of bad things happening.
It's a fantastic answer, Chris. Listen, it's great to see you. Thanks for bringing some thought-provoking charts with you. Stay safe. Be well there in Atlanta. We'll talk to you again soon.
It's great to catch up. I appreciate the invitation.
That's Chris Ciovacco. Chris is the Chief Investment Officer at Ciovacco Capital in Atlanta, Georgia. I tell you what, I talk with someone like Chris and I see the charts that he shares. I'm envious at how he is using the StockCharts platform in a way I could only dream to, of really telling a fantastic narrative and really demonstrating how the market has evolved over time. I love his answer at the end, by the way. If you really caught it, there was some great wisdom in the way that Chris answered that question. How are you positioned today? And he said, I look at the charts, number one, I love that. Then I think about how I'm positioned. And every day I ask that question. What am I seeing and how am I positioned? Are those in line? And I think that is a brilliant way. We talk a lot about routines. I talk with my premium members at Market Misbehavior about routines and discipline and going through a process. And I think Chris made a beautiful argument for the benefits of looking at the charts first, thinking about positioning second. Folks, we got to wrap this show and go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I'm going to start with my market trend model. I loved Chris Ciovacco's weekly chart of the S&P going back to 1990. Really interesting thinking about that along with the TSI, or the True Strength Index, which is an oscillator similar to things like MACD and RSI and others to help us measure strength and momentum. My weekly chart of the S&P is really capturing 3 different time frames: long-term, medium-term, and short-term. If you look at the labels at the bottom, you'll see that as of last Friday, all 3 of those, for the first time since back in, March of 2022, I think it was the last time they were all positive, but really glaring positive. We have to go back into 2021 for a configuration like that. It's a rear buy signal from the long-term model. What it tells me is overall the trend conditions are healthy. The concern I have are some of the things that Chris and I were talking about right there, right? Particularly underneath the hood and some of the individual stocks, things like industrials really retracing after having a period of leadership. Chart number 2 gets me to why I'm not just raging bullishly telling you that the market trend is positive all across the board. It's because traditional measures of breadth are not as optimistic as I think they could be if this was an all-clear sort of environment. You're not seeing the new 52-week highs you would in this, which would be sort of classic for this part of the cycle if it was a sort of a new bull market phase. And offense and defense are certainly leaning more toward defense than offense. We're looking at 2 ratios here. This is a newer chart you might not have seen before, but the top I'm using a familiar ratio, consumer discretionary over consumer staples. The fact that this has been going down all through February, all through March, and through early April tell you that defense is working over offense. At the bottom, I'm looking at the relative strength of utilities, but flipped upside down. If this is going up, the S&P is outperforming utilities. If it's going down, the S&P is underperforming utilities. I would say both of these are more risk off, at best neutral. So that is not the environment that tells me to be super optimistic. Final chart is ADI, analog devices, obviously in the technology sector. I did a YouTube video earlier today on my Market Misbehavior channel talking about bullish engulfing patterns. I wanted to highlight this pattern yesterday. It's a 2-bar pattern. So Friday's down move, that was Thursday of last week. Lower open and a higher close. That's the bullish engulfing pattern happening right at the 50-day moving average. Simple charts and candle patterns still work. Folks, that's a wrap for the show. Thanks for joining us every weekday after the close for the final bar. Special thanks hanging with us this week as we get through the technology challenges of doing things remotely. I want to thank Chris Ciovacco, Ciovacco Capital, sharing some fantastic charts from Atlanta, Georgia. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.